Welcome back, everyone. Um, it's been a good week, busy week, getting ready for you know what, getting down to the wire for the new product that's coming out. Yeah, good week, and I judge good weeks by whether we've had some good podcasts and tweets, and we have. We've got some really good podcasts this week. Juicy, Top Traders Unplugged with Alan and Niels. Very good stuff. I posted a lot about that. I want to talk about that. Um, and also, I got to finally, Covell posted the podcast with Mulvaney on YouTube, which means the transcript came out, which means I can, and it was such a poor quality audio. And then the accent, wonderful accent, but I need to see it in writing. So I was able to get started on that yesterday with some good quotes from Paul Mulvaney, but was not able to finish. So there'll be a lot more coming out. My twist, what I think is important about all of that. And it's not even everything because, even with Niels, there was so much good stuff towards the end. Mostly criticizing things that I say, kind of, not criticizing me, but just I couldn't even tweet all that. I just copied and pasted it and into a document so I could read it off. There was too many good things that they were saying that there was it just got beyond Twitter. So if we have time or if anyone's interested, we can discuss the last part of that as well. But too much good stuff. Too many things to write beyond Twitter's ability. So yeah, the markets, the grain markets. I went from short corn and beans to long corn and beans very quickly. Almost got knocked out of my meal. My pants were so loose on the meal that I stayed in and had a monster rally. And then I tweeted that part from a friend on Twitter. He came up with this idea, that tweet. I gave him credit for it too. Meal limit up, oil limit down. Aren't they the same markets? That was pretty funny. Good example of trading all the markets because sometimes they don't look the same. And yeah, very interesting on those grain markets. I like trading all the grains. I trade them all that's humanly possible. So from Tampa, Florida, the United States, very fun. I trade a few I should not trade. So yeah, milk, rough rice. Anyways, um, what else? Gold and silver. My God. I was listening to a podcast the other day, and it said they were asking this trend follower, "Are you long gold?" And they said, um, "Of course. How can you be a trend follower and not be long gold?" Not so sure about silver, but yeah, gold for sure. And I'm like, they're the same chart, and they both are crashing. So yeah, gold and silver have done nothing. The worst markets ever. I remember back in the 80s when we first started trading for Rich. It was coming off of massive inflation, and so the inflation thing was there that it was going to come back. Of course, we got to always be on guard for inflation. And his response to hedging himself, his wealth, was to short or to buy things other than gold and silver. Like I'll buy anything other than gold and silver. That's over with. That's played out, which is probably not a bad mentality to have. Just don't expect the markets to act the same. I certainly have never embraced, well, I don't pay any attention to history. History is not a good guide for anything except the back test. One entry, one exit, stop loss, 5,000 trade back test. Here's a good place to buy. Here's a pretty good place to sell, and then go forward. But history repeating itself, and I've never enjoyed or never given a thumbs up to history doesn't repeat itself, it rhymes. I would be embarrassed to say that. I just said it, but I mean, I would be embarrassed to believe that. Maybe. I don't know. It's I don't know. I just can't. It doesn't sound like you're very serious about analyzing things. Okay, I could go on. Oleg, how are you?
Hi Jerry, hi Maurice, hi Richard, hi Brian, hi Bruno. I have seen here Seth and Alp and other guys. Of course, as I always say, and I'm sure, absolutely sure that we'll always say that I'm very happy to be here in our trend following plus nothing trading club. And I had a nice swim in the sea today. Now I'm in the wonderful forest. So all I love is combined now. So I want to say that I was listening a podcast and doing my notes, a Fat Beach podcast with Jerry, and I want to say that every conversation with Jerry I have ever heard is a great event in the financial world. It's a great event, and every time I think how wonderful it is, how new for me it is for few years. It's a fact that few years, and I listen to the same things, but it's so wonderful. I love it so much that it's like I listened it the first time maybe, and so I often do a back test after this. I'm so inspired by this, so I will publish my this notes from the Fat Pitch podcast maybe tomorrow or today. So great. And of course, it's very great to be here. And I hope that my technology's problems will be less, at least less today, because I face a lot of technology problems for maybe 3 or 4 recent months with this our spaces discussions. I don't know the reason why. So I'm very happy to be here, and let's get started. I'm sure that it will be a wonderful conversation. I'm sure because all our conversations are wonderful.
You guys should be really jealous that you don't have a fan club led by Oleg like I do. So thank you for all that, Oleg. Oh, sorry, Bruno.
Yeah, no
Sorry to
problem.
cut you off. Go ahead.
I was just going to say the pretty much the same thing. It's great to be to talk with you guys every Friday, and I can't stress enough how Oleg expresses this feelings for all of us. I guess it's I think it's really important, especially in those weeks where the trend following systems challenge our convictions in it, and this week has been one of those, I guess. So now getting to the meat of it, and Jerry just said that history doesn't repeats itself. I won't repeat the quote exactly, okay? And that is not a very good guide, except in the back test. I tend to agree with you, especially because we tend to look at these historic episodes and try to get too much information where we should get only a bit of information. Just treat it as a single data point from an ocean of data. And but then you went on and said that the backtest tells us that this or that breakout is a pretty good place to buy or a pretty good place to sell. And this past days, I've been running some new backtests on a new data set that I just get that I might be trading on it, and trying to see if it's similar to I get similar results when I look at the futures markets. And then I got some new ideas of how to evaluate the systems, how to compare them, what variables should I look. And yeah, the two most important statistics I get from a backtest every time is the hit rate. That's the percentage of positive trades, and the win-loss ratio. That's the average return from winners divided by the average return of losers. But I would like to hear from you guys what you get from a backtest. How do you compare systems? How do you say that this system is better than that other one? What's your gauge of comparison.
Hey everyone. Hey Jerry. Hi guys. Oh, it's what a week it has been. So, I'll come back to Bruno's question. Just quickly on the podcast yesterday, I was listening the Ellen and Niels's um, podcast, and I think what happens is so one of the things that they've discussed there is diversification. So, I think we are on more or less on the same page in terms of the diversification. They say that diversification is good, which I agree. Um, they also said that you do not have to do the same way. You do not have to trade the same way. There will be some differences, and I think those differences are very important for me to be able to, self-express yourself with the work that you're doing. So, which I would agree. They said that in the podcast, old school is better. Niels disagree, but he didn't give a definition of what is better. So I think it was so I that part I didn't understand. So better in terms of Kager, yeah, because we are not cutting our winners short. So we will have a bigger kegger, but I'm not quite sure what he meant there. Where when he said he doesn't think the old school is better, better in terms of what would be the question, I guess. So the next thing is he said best managers excel over time are the best risk managers who does real time risk management of correlation and volatility management. And of course, it's not possible to agree with that, but it is somewhat scary. You know, it is somewhat scary because when people who have the microphone have views like that, and their only guest is Richard Brennan or Jerry Parker, and there's no one else, and there's no one else actually can spread the good message. So I'm finding this scary in the sense that there's nowhere else to look for the right information. So basically, letting your winners run to the end is the right attitude, but no one says that. So it means that it is very tough, really. To be able to get to the right place is very difficult, and so that's why I find it a little scary. So they also said that some firms use long bias. Yeah, hey ho, I don't do that. They said they don't short. Some firms do not short bonds because it's a safe haven. I said, when you're risking small, why do you care? Then they talk about AI, and they basically dissected AI into bits and pieces. But I am using CI everywhere else, not AI. CI is the computational intelligence as opposed to an artificial intelligence. And my calculations and the betting model, the trend following betting model where you're betting small across a hugely diversified universe wouldn't change with AI. It doesn't matter whether you're using AI or CI. Your Python, your Java, your C++, your C Sharp, these are all CI. Okay, AI. AI is the artificial intelligence, and you can exactly code to do the models that you're working today like that. So it's just the code. The coding is a tool to be able to do what you want, the way you wanted to trade. So, and people, when they are breaking apart AI into bits and pieces, that it is not helpful on the trend following space. I mean, just give me a break. You have to say that. You have to say the truth. Truth is, you haven't used AI in your models. You have coded those models many decades ago or many years ago, which is absolutely fine. But the right way of saying it is, if I would have used AI, I still would be taking the same entries and exits and the position sizing and the same models. So it's I really do not understand when people break apart the AI. And possibly they do this sort of stuff because of the marketing. There are some AI strategies and AI hedge funds and AI, they are trying to raise assets under management, and the things got a little bit confused, with, so AI is not the strategy. AI is your code base, and the message is, if I would have traded, with the AI, I would have taken the same trades anyhow. So I think that's what I'm trying to say. Yeah, I mean, it's been really helpful. It's just actually just shows the importance of the conversation that we are having here. And, it is scary because there is nowhere else you can find this sort of information where and that part is, there are some questions around, and I think I also like Richard Brennan's podcast with the Moon Post, the latest that he actually posted. So it's good to spread the message, but there are not many people who are spreading the message. So just I wanted to share it. Thanks, guys.
Hey, everybody. Good morning. Going back to Bruno's question about what kind of metrics to use to kind of evaluate systems, I like to use expectancy. Just run a back test and see, comparing, a breakout versus some other type of system. What's the expectancy? I know a lot of people like to look at win-loss rate. That doesn't matter so much to me as the expectancy does.
Yeah, I think the expectancy is the. I used to think that's the single most important one, because it combines the hit rate and the win loss in a way that you can compare things. It's easier to compare one number than two, I guess. But then I was wondering if that's the ideal statistic to look at, because we are dealing with extremely fat-tailed distributions. You may get a result in a backtest that you get a high expectancy because of one single trade that hit the ball out of the park in a really hard way, and all the other trades in that backtest are slightly negative. And this one single trade may compensate for all the others. But when you get to real life, you may have to wait for years until that one single trade shows up. I know the solution to that is trade small, is trade a lot of markets, etc., etc. But I was wondering if isn't there a better way to evaluate the systems. The other the usual solution to that, when you're comparing distributions that have fat tails, usually it's better to use the median instead of the mean return. But that's not exactly what we are doing here. We are aiming for the outliers, so the median is not exactly the best one as well. The way I compared this in this round of backtests, I calculated the Kelly statistic, or the Kelly ratio, or Kelly proportion, and the Kelly criterion, better to say, for each backtest. So I calculated the hit rate, I calculated the win-loss ratio. With these two numbers, I can get the Kelly criterion. And that's the statistic I'm using to compare. That's the number I'm using to compare my systems. I know there are some Cali fans sitting on the bench here. I'm looking at you, Absolute. But I don't know. I'm willing to discuss this idea or any others.
Yeah, I mean, I look at the trade stats, exactly what you've been talking about. I think certainly the expectation per trade is the first step for me. It's the first step. If it's too low, it's a no-go. We got to do something else. And then if it's okay, it's a juicy average trade, then okay, let's dig deeper. But I'm not going to go too much further if the average trade has really fallen off. Now, I think win percentage is good. Um, I look at the the average win and the average win versus the average loss, and I'm sort of going to use that as my risk measure. Like I'm risking a number of ATRs, and 60% of those are losers. There's my standard deviation. There's my denominator. And then I'm going to say, okay, how good is that average trade? Pretty positive compared to that. And so, one of the things that is that I don't really have much, I'm not going to spend too much time in this area to begin with. We've already spent a lot of time over the years, and we didn't really come away with very much than our initial observations to diversify, have loose pants, go with the trend, take small losses, let profits run, not use price objectives disguised as volatility and correlation management overlay. And one of the reasons that we don't go very far with this obsession with backtesting is because at some level, once you get a certain look back, the minimum look back is going to be X, the maximum, okay, we're not going to go beyond that. Things are not even starting to fall off, but there's a swath of parameters in between there that why go longer term? It's not really improving things. It's just going to cause you more headache and pain. So I'm all for loose pants. No one has looser ones than me, but at some level, it doesn't make a lot of sense to buy the 1,000-day high breakout. My God. So the problem with when you look at these is that there is no problem, and it's that all of these parameters make about the same amount of money over the 30, 40-year back test. So you're like, what? Yeah. So all of the breakouts that I'm choosing, they're like have the same performance. Now, the shorter term ones have a smaller expectation per trade because they do more trades. And the shorter ones cause less headaches because they're shorter. And you take those profits just a bit quicker. And sometimes it works out, sometimes it doesn't. But and they're still not short term in anybody else's mind except my own. So I thought it was interesting I wanted to comment about this, dive into the middle, sort of the beginning of Mulvaney, where he is talking about creating systems that, and seeing what is going on. And he's like, well, I kind of knew that this stuff worked because other people were doing it and making money. So that's kind of an edge to have a basic framework down. And then you can kind of get more fired up when you kind of know there's probably going to be something nice at the end of the rainbow. And then he said people were skeptical that this is not commercially viable. I love that. Not commercially viable, but I kept at it. I wouldn't stop. I kept the same strategy. I pushed ahead. And then I've traded the same system since 2005. And I was thinking, yeah, you hear a lot about evolving CTA. This comes from the marketing of the SocGen 20 managed future CTAs. It's evolving and adapting, and machine learning and AI, and any sort of thing that pops up, they're going to say, "Oh yeah, we're doing that. Oh yeah, we're doing that." And it's in my mind, there's probably a fair amount of justifying higher fees. That's one of the things that you kind of need to do, and emphasize the complexity and just the willingness always to take on something else that's in the media to see if that's going to help things a bit. And I was just thinking, yeah, if you start out with the really loose pants and all those trade stats are looking really good, it's probably over time going to be very difficult to notice in the back test that tweaking that a bit is going to make a material difference. You're already trading multiple systems, multiple entries and exits. They're already showing you that they make about the same amount of money. So you're kind of in a box where you're like, I'm not going to change because I'm already trading. Every one of my systems except one is not optimal. They're all not quite as good as the best one, but I don't really think that has much to do with what I should expect in the future. So I feel kind of the same way. Once I got it right, in 2005 for me as well, I decided, long term, right, get away from 20 and 40 and 60 days to hundreds of days as you look back. Then I really put myself in a situation where continuing to optimize and agonize over backtesting became less and less important. And I had no incentive to, because no one was having consistently better performance. And my performance was good. There'd be times where there were no trends, so I'm not going to get rid of it, those systems. And then Mulvaney goes on to say, I reread this tweet of mine, and I don't know if I got it right, but I included the link to the clip, and those are always interesting to listen to. So I try to put the link in there that goes directly to the quote, so you can just hit the link and listen to it. I have to sort of edit these quotes sometimes to make them fit into Twitter. But then he says, I lost my train of thought. But someone take over.
You were saying about the systems that are not commercially viable. Well, but this I think
right. Then he goes on to say. I've done research on systems that are vastly superior to any trend following system that's out there. I mean, these are his words, not mine. So, and then he said, but when you run the systems enough in the backtest, they have these tremendous drawdowns, not trend following systems that are better than trend following, or trend following systems that are better than any other trend following system out there. This is what he's saying. Then he says, and then they have this huge drawdown. And then after the huge drawdown, they go back to making lots of money. So he said, even if you have a huge drawdown, it's not a signal that, the system is broken. No, it's not a signal that it's broken. That's the bummer. There's no light switch. When they turn the light off, then I'll know. And then he also says, people don't even want to contemplate what can happen in these systems. And I think this is the root of our rock solid argument. And when I get off the rock solid, because I get tempted to get off, because there's a lot of other little sexy things you can talk about. and I get onto those, but I always get reminded, because I'm starting to, my argument in my own mind starts to get a little off being very solid. Then I have to get back onto the rock solid ground. And that is, it's the sample size. And as Mulvaney says, people don't want to even contemplate what can happen in these systems that has never been seen in the backtest. I think that's the problem. You can go into battle every day with this ultimate Achilles heel, and it never shows up. And then all of a sudden, it'll show up. But some people will die, and they'll go off into the trend following and hedge fund hall of fame, never having lived long enough, because eventually they would have suffered a similar fate because they had this weakness. And this is, I think, the problem, is that the weaknesses show up, or the drawdowns come along. It's a false signal. It's really not a system you should get rid of. The systems never have this problem, or at least in this 30, 40-year back test or career, to quote Niels. Then that proves, this is what Niels was saying at one point, that proves that they can't be touched. And I don't think it does prove that at all. And I think that's our ultimate argument. So your ultimate argument is be afraid of something you have basically very little evidence for. I'm like, kinda, yeah. That's kind of the problem, is that we're not perfect. We might have problems with our system that don't manifest themselves with tremendous problems until much later. And then, even though I agree with Richard that the 30, 40-year backtest is the best evidence, it's not perfect evidence. And when you have this drawdown, that too is not evidence that you should get rid of your system. So I think it's very, very interesting.
I have said before that, first of all,
this
the
goes
drawdown is the
right
price we
to the
pay
point
for our
on
success.
I'm
And it's
trying
very important to understand for
discuss
all
to
of
achieve
us.
here.
And of course,
And
like Niels said, and other guys say, that people prefer to fail conventionally than to do it unconventionally. So if they, Jerry said this, as I remember, that if a person loses 5% with a in a SP 500 index fund, it's okay for him. And if he loses it with a safest and best trend following approach, he doesn't like this. So here is a human bias. Here is a problem, I think. But drawdown, as I have said before, it's like when we are in a coffee shop, we pay for coffee, we pay money for this. It's not a free. It's not free. So drawdown is a necessary price. So we must understand and love this like a part of our process. And do backtest and do, like Jerry said, what the computer says for us. And watch this again and again, do the backtest again and again, understand our processes. I think it's the way to understand this.
sorry about the interruption. My connection is not always great. And yeah, I agree with all that. I agree with all that. The information we get from the backtest, we have to be extremely cautious about that. And I guess this is what brings us together here in this trend following club. The reason we like trend following so much is because it's so robust against all sorts of unexpected events that we might find going forward. I guess all other strategies out there, systematic or not, are not as worried about the future as we are. And yeah, but we have to try to get some conclusions from that back test. At least to be extremely, to be extremely cautious about the back test results doesn't mean we have to throw away anything we get from there. And that's what I'm trying to. That's the discussion I'm trying to provoke here. What's the I'm not so much interested in the limit of what we can get from the back test, but I think we can be we can go closer to that limit. And an example you just mentioned, Jerry, that at some point in time you get convinced that the longer term systems are better than the shorter term. Something convinced you. Was it the expectancy? Was it the behavior of the trends? Were it some examples? What would you say that's the most important argument, quote unquote, from the back test that convinced you?
Well, certainly, from my early days, you know what that means, December 1983, there was a big emphasis on expectation per trade. Okay, so that was ingrained in me. What else? Nothing. Pretty much nothing. Certainly, the idea that most people kind of agree with now, to some degree, I think I've become a moderate on this, and that is the win percentage is the least valuable metric out there. I kind of agree with that. Obviously, I think back to what you were. I'm going to lose my train of thought, but I'll take a risk here. I don't think what you said earlier. This just popped in my head. I don't think that I haven't seen that to be a problem where you said something about if you look at the trade stats or the average trade, you can get a false. You can get some information that you don't really think is that great due to the fact that one of the trades was too large and it over influenced. I don't. That's probably more of a symptom of your back. You didn't use enough data, but I've never seen that in a 2030. Because at one point, what did I say? Well, we just did our 20-year back test. Then 10 years later, I said, oh, we did a 30-year back test. So now, I guess it's 40 or 50. I've been around, so I have not seen that issue in the back test. You throw in if we get the greatest trade of all time now, and we run it through in 2023, and we get that, and I add that trade to my 50, 40-year back test, it's not going to move the needle very much. It's not going to make me choose a different way of trading because this particular this particular trade maxed out at a certain breakout, and then that is going to make me want to trade shorter term or longer term. So I have not seen that happen. Okay, now, back to your question, I think so. I would just approach it in 2004 and five as this is kind of not working. We're getting bounced out of trends, so I didn't need to know that. Didn't need to run the back test to see that. We're having trends, but we're not making money. If an inexperienced person looked at the chart and they'd say, "Wow, look at that trend," and I would say, "Yeah." But I got out, I got out to get back in, got out, got back in too many times. So I really didn't make money on that trend. So then I would run through the charts of the big trades and I would see, oh, I see these big trends now. I would put up weekly charts. If you put up a weekly chart, boy, you really see some big trends. But, you're going from looking at, average holding period of 2 or 3 months to an average holding period of 9 to 12 months. And so, okay, that's new. Let me get into this. Then you run the back test, and the back test confirms it. Oh, yeah. Going back through all the data, your average trade is better. You make more money. You're not getting whipsawed as much. Bump it out to a holding period of 9 to 12 months. Things are looking much better, much easier. Drawdowns are bigger. Sharp is worse. And you get a little, tricked by the average trade getting bigger, as I said earlier, because it's at some level it just becomes a function of the days you hold the trade. So the shorter term look back makes more money, but it got out and got back in some trend, whereas the longer term just never got out. But it gave back a whole lot more at the end. So the shorter term system ends up doing better. The average trade is worse by a little bit because it's just a function of how many trades you did, and so it gives you a false illusion. So you don't want to pursue this maximizing this average trade without regard to other things. So my preference is to trade as long term as possible, and I keep asking my research people, "Are you sure System 1 is still good? Is still making lots of money, even though it's shorter term?" So I've totally drunk the Kool-Aid, and I'm like questioning the shorter term stuff, which no one would ever would agree is very short term at all. What do you think?
Yeah, the problem with the longer term systems is exactly that sample size thing. The longer term systems, because they do less trades, they have a smaller sample size and gets harder to compare things. It's as if I have a lot of confidence on the results from the back test on the shorter term system that gets tens of thousands of trades on all the markets, and so I'm pretty confident that hit rate, that win percentage is pretty accurate. It's a representative of what I'll get going forward. The expectancy of trades, it's pretty accurate. I can have some confidence that it's going to happen going forward. But when I get to the longer term systems that has half of that sample size or even less than that, then I'm not as confident. It has better statistics, usually a slightly lower hit rate, a slightly better win-loss ratio. that produces a higher expectancy per trade. But the thing is, my confidence interval is wider. So when I try to compare with the shorter term systems, I have these doubts. And when I run the backtest and compare things across time, I mean when I put the trades in a line one after the other to get an idea of what would be the equity curve, then I see that the longer term systems are better, and they have some property within themselves that make the trades, the ensemble of trades better than the short term systems. Perhaps that's the consequence of that that phenomena you just mentioned, Jerry. That's you're getting out of trades too soon, and the longer term systems are not. But yeah, that's where my doubts come from. The sample is smaller, and I have an idea that's the better thing to do. This idea is reinforced by the conversations we have, the interviews I see out there from traders that are more experienced than me, but that's it. And yeah, I'm trying to test all of our convictions here. That's what I'm trying to do.
Yeah, fair enough. I agree with all of that, and I think to me, it's important to have these convictions, which we kind of have, and then call them out, and not be afraid to say, because I think on one hand, you can't go around yapping about sample size all the time like I do, and then not sort of realize that it's what you just said, basically, that, hey, you want to have these loose pants, then you then talk to me about your systems and its sample size in just the way that you did it. So yeah, that's very good. Now, one of the things that we would do when we started trading single stocks is we would include the stocks. Okay, so then you're not limited to the futures markets, and so then you start bringing these stocks in. So now you're like, oh yeah, if I bring the stocks in, I'm kind of offsetting some of the problems with the long-term sample size. I've got thousands of stocks to test versus hundreds or 100 futures. And one of the things we found that we were bringing these stocks in the 2000s is that they were very profitable. They're very, very profitable. So we were increasing our sample size, but we were skeptical because they were too profitable. They were too good. And they would influence the parameters we chose because they were basically, we lived in this magical time since basically since 1982, August of 82. Stocks had been very strong for the most part, with a few short-lived sell-offs. So we would, and the stocks preferred in our back test the longer-term system. Like they wouldn't even like system 1 or system 2. They'd say, "Oh no, give me system 3 and 4, and maybe how about introducing 5 and 6? I really like this long-term stuff." So we had to be very careful. So we're picking up sample size. We were including the equities, but we felt like it's making us look too good, and we're going to overwhelm all the other markets because the stocks are dictating how we're going to trade. So we were trying not to allow that to occur. So I guess all of that is not as important as you can increase your sample size if you add in equities, but you got to be a bit careful. And there's probably people out there who are like, "Oh, you can't include equities with your back test for futures, currencies." That's why I don't call them futures. I call them currencies, commodities, and interest rates. But it's fine to include the indices, of course, because they're futures. Yeah, such nonsense.
Going back to Bruno again, talking about the instance of like one market influencing the best parameters of the expectancy. I've noticed that comes up when adding new markets without taking into regard the liquidity of the market. Like, say you're going to add something like a new feature like the Argentine peso or something like that. You got to be really aware of the liquidity of that market when it started out. You might have some really crazy moves because there's no liquidity in the market. And I've seen before doing testing for other people that trade a bigger market set than I do that come up where you have to have some kind of, you have to really look at a market when you add it and make sure you would have actually been trading it at the time in the back test, where you probably need to have some kind of liquidity filter that says I don't look at the signals of this market until it reaches a certain level of trading activity. And probably the same thing with stocks too. You probably can't just add the whole history of a stock to your back test. You'd have to really look at it and say, hey, is this a stock I would have actually been trading in real life conditions?
Oh yeah, I'm coming from more of a theoretical point of view than a practical one here, and I might have given the impression that I've run back tests in which one trade determined the result, the positive result in a bad way, but that was not the case. What I'm saying is there are some data distributions out there that have no defined expectancy, and I'm not I'm not exactly sure what's the distribution we are getting from our sample of trades on a trend following system. It might have these properties that those distributions that have no defined expectancy have. If that's the case, we are wrong in comparing expectancy within a sample. And there are better ways to compare these samples than the expectancy, because the expectancy is not defined. So it's this fear of that case being the truth. I'm not saying it is. I'm saying it might be, and it's the fear of that possibility that got my mind running on those alternative statistics to compare the samples. That's it.
Well, another thing is that when you run the back test over a lot of parameters, like I just described a few minutes ago, and they all come back with almost exactly the same performance. All right. I don't think mathematically that means anything. Okay. But just between you and me, it makes me feel good. Okay. But it doesn't help your sample size, Jerry. I understand. I understand. But I feel better. You shouldn't be feeling. I know I shouldn't be, but I do. And another problem, Niels, what did he do? It's a long list. Niels and I had this email between each other where we were joking the other day about all these messages we send each other on our podcast and on Spaces. So we do that. We thought it was funny. So he's listening to me. I'm listening to him. But he's like one of my favorite friends of all time. So it's all good between us. It's all good now, but what happened with Andrew and Tim Pickering, maybe it was all good with them until they got into that death match. So, no, I'm joking. But one of the things he said the other day, is that he didn't remember all the times that I had told him that, he was belittling. Oh, yeah, he got confused, or he doesn't agree. Obviously he's confused, but doesn't agree, or he forgot all the times I've said to him And then Alp was trying to get into this with Mike Shell a few weeks ago. And I was like, Mike, come on, stop. And that is, Alp's done a really good job on Twitter and probably on Spaces trying to go with what I came up, well, not what I came up with, but something I agree with, which is when you do this counting of sample size, you have to put them in buckets. So you've got the entry, breakout entry, breakout exit. That's a bucket. Count those up. Entry, stop loss. That's another bucket. So we're not even saying you can count those together. It's like the systems bucket. No, it's the entry exit bucket. And so Niels is making this point that when we add in volatility and correlation management, and do all these trades every day, getting this portfolio all scored away based on volatility and correlation, that's a lot of trades. We have a lot of sample size. And we're like, oh, no, that's not how it's done. And if he said, oh, I understand what you're saying totally, but you're wrong. Oh, okay, then I respect that. But but that's would be a hard one to pull off, I think. Now, if he was like a mathematician like Richard, then I'd say, oh, okay, Jerry needs to be quiet and let the grown-ups talk about sample size in math. But even grown-ups get it tremendously wrong because they have their own ways of looking at things or biases, just like I do. But I do get a little bit, once again, I get a little bit of comfort when I look at my average loss with a stop loss and with my stop loss. And it's the same number. My average loss is the same. It's the same with the stop loss, and it's the same without the stop loss. Because I've sort of optimized my stop loss, irrespective of trying to target what the average loss would be without a stop loss. But it just so happens that's what I stumbled onto. The average loss is the same. I mentioned this many times. I don't even know if it means anything. Okay, so if I look at the back test with the entry exit only, no stop loss, the back test has about the same performance as when I use the stop loss. Now I am able to increase the sample size on that back test because there is no stop loss. Now I don't trade that way, but once again, it makes me feel better. I've increased my sample size. Hell, 60% of the trades were losers. And the vast majority of those were probably got out on the stop loss. But you can get a loser with the breakout exit as well. But I'm really increasing my sample size, right? With my bucket approach that Alp told me is correct. Okay. So you could say again, well, that really isn't good enough because you're not trading that way. So you can't go around feeling good about increasing your sample size, but you don't even use that system. And I'm like, oh yeah, I know, but it makes me feel better.
Yeah, I'd say that
Is it
it would make me feel better as well at first, but then the chaser is, oh my god, I'm overfitting this I'm addicted to this kind of backtest, this kind of choice of parameters within my backtest. I'm overfitting this stuff. I'm committing a grave mistake here. The reality doesn't support the same results for a different backtest. Something's wrong.
No, I'm doing the opposite. I am reducing my parameters. I think that's the right thing. If I'm reducing my parameters, I'm getting rid of the stop loss, and I'm saying, oh, I'm picking up sample size, and performance is the same.
Yeah, you're right. That's the right thing to do. I'm just saying that the feeling I would get, the first one would be joy. The second one would be anxiety. That's what I'm saying.
Is it perhaps that the stop loss in this case is wide enough so that actually it doesn't matter whether you have it on or off? Is that maybe one a big factor here?
Exactly. I mean, that's exactly what it means. It means it's optimized. So it's not, I want to get out quicker. I think a lot of, silly me, I optimized it. And then I hear other people, they have 20% winning trades. And how do they come to that number? The stop loss is so close and so tight. It's so suboptimal on the back test. So, it's, and so what were you solving for, Jerry? I was solving to make the most amount of money, given the amount of money that I'm going to lose per trade on the stop loss. That's exactly what it's saying. It's saying, um, yes, you're right. This is the optimized distance to have sort of looser pants on the stop loss, which sounds very contradictory, and you make the most amount of money. Not too close, not too far away. It's an optimal loss, not a small loss. It's the optimal loss. And then it says, and in fact, your average loss is going to be the same. Then, of course, we'll say, ooh, I've learned to ask questions when someone says average. So what's my biggest loss that I've had with that without a stop loss? Oh, 3, 4, 5 times the average. And what's the biggest loss I had when I used that stop loss? Twice as large. Twice. Once it was twice as large. But if you don't have any stop loss, the maximum is many times. It's 2, 3, 4, 5, 10 times possibly. You know. So therein you say, oh, okay, all things being equal, I'll take the stop loss.
I see. So, question on the long term perspective, right? Because obviously, the higher your time frame, the longer term you go. But has anyone done a test in terms of using in the strategy multiple time frames versus just a single time frame, and see how that affects things?
Apologize, I got distracted. Can you repeat?
I was asking in terms of the long term perspective, whether uh, any testing has been done of using multiple time frames versus just a single time frame. So obviously with multiple time frames, you have multiple confluence of different time frames that you need to have before you execute. But just seeing the difference there and how that impacts the performance. Just curious about that.
Oh, yeah. I mean, we've said many times, Richard is a huge proponent, and I agree. I trade 4 systems, but at one point when I had a large staff, I traded hundreds of systems, so most of the time they wouldn't, we weren't actually doing the trade because, when you're trading hundreds of systems, I don't care how much money you have, you're going to get some fractional trade. So it wasn't like we were actually doing a trade, but we were like, let's just run the gamut in increments of 5. So we'll do the 75-day high on out to the multiple hundreds of day high in increments of 5. So sure, and just for the hell of it, I think the breakout systems, they're not great if you're really intense about spreading out the entries. They're not that great. And then if you're spreading out the exits and having different exit spots, they're a bit better, but they're not always a bit better. So, and Richard has mentioned recently, I bookmarked some tweets of his or of some other people commenting on his, and it was, I think it's Richard's quote. It was something along the lines of, the more systems you trade, the more outliers you're going to probably pick up. And I think that the way that makes sense to me is, I think that's true because sometimes, as I've said before, the outlier and the size of the outlier is really just determined by the system not knocking you out of the trade before it's done with this big move. The market is done with its big move, and it allows the system to keep the original ATR. So the ATR was so small that you had this gigantic position. Like I said with Tesla, I think the entry ATR was 87 cents. So if you held that position, and the loose pants systems would probably hold it, obviously better than and have a way bigger drawdown then you're going to have that monster position on based on 87 cents. My God, that it's going to make a killing. And so you don't want to have too many of these shorter term systems that went up 50 ATRs, it retraced 49, you got out. Oh, then it goes back to the high. You have to resize with a new ATR. So mixing up these entries and exits, kind of accidentally, inadvertently, you kind of create an ATR. I've seen situations where my system bought the market in January. It went sideways for 6 months, and then all the other systems got in 6 months later at a much higher ATR, and then System 1, once again, had this ridiculously stupid ATR. It was so low, position was so high, and it went nowhere for 6 months. So why not have an exit that says, hey, if we haven't made money in 6 months, let's exit? Well, sample size reasons aside, because you sit there with this trade that can possibly explode. So I do think, okay, Richard's online. I want him to comment on this question as well. Go ahead.
G'day, Jerry. G'day, everyone. Jerry, yes, look, the way I view the multiple system approach is that, I'm always worried about selection bias because our ability to catch outliers is twofold. One is the market delivering the outlier, and second is our system's ability to capture that outlier. And each of our systems has constraints in it. It's stops, it's trailing stops, where they're positioned, etc. And you can be snagged out with some of these chaotic moves where, and you might find that it takes a long time to re-enter that trade. So, a single system inevitably is going to, when compared to an ensemble, is inevitably going to have a touch of selection bias to it. And that's why also I don't like using statistics to evaluate my backtest, because out in the regions of the tails, the statistics really have limited information for me that I can use. So I'm much more much more keen to use things such as design logic, things such as maximum diversification, things such as ensuring that our systems cut losses short and let profits run, open-ended in nature. The design logic to me is the imperative thing. The actual performance or the statistical performance is how it has performed over a backtest. And I don't necessarily pay much attention to that performance, provided I can, what I call, map to the market. In other words, when I look at the price data, in hindsight, you can always tell these outliers. You can't in foresight when you're trading them, but you can in hindsight. And in the backtest environment, that's a perfect environment to use hindsight to evaluate how well your systems can capitalize on the fruits of the outliers. And if there are no outliers, if you're achieving positive performance, it's either random luck or it's because you've overfitted your systems to noise. So the ensemble approach to me is a means of ensuring that the golden rules of logic are applied to all of my systems, but giving me maximum diversification with those systems when addressing a single market. So it just gives me this ability to avoid a selection bias in determining a single system for that market and applying almost a machine gun approach as opposed to a sniper's rifle approach to an outlier, because they have all of these different forms. In relation to the question regarding medium to long-term models, why do we find that our performance nestles in the long term? Well, I sort of revert to Perry Kaufman's viewpoint here, in that in any liquid financial market, a liquid financial market itself is what we call an asymmetric open system. It's closed at its lower bound. In other words, the fundamental unit of a market is what we call the tick, or the transaction, which is closed. It's finite. And as you add more and more of these ticks together, you start getting a price data feed together. So it's asymmetrically orientated, a lower closed bound, but then over the course of time with these ticks and the way that price consolidates, you find that certain features of that price data start amplifying, and it's the amplification of that price data that leads to trends. So the reason I like long-term models with my trend trading is that in the world of the financial markets, we know that there are maximum participants that are influencing the form of those, the longer term data set. So you get the high frequency traders, you get the hedge funds, you get the institutions, you get the pension funds, you get the pension plans. All of these models are over the longer term time frame influencing the behavior of that price form, as opposed to concentrating, say, on the intraday market, which might only be sort of active by the majority of high frequency traders, short-term traders, day trading, all of that sort of thing. So as you slowly go out to the sort of medium to longer term, you find that there is more and more participant behavior influencing that price series. And the way I see trends unfold is this amplification of positive feedback that's driving those trends with that serial correlation. So I think naturally our systems, our trends are going to be better in the medium to long term than they are in that shorter term environment, because in that shorter term environment, most of the trading activity comes out as noise, because the nature of the participants there are not significant enough to create these amplification effects. So there's a lot of noise in that the lower order time series from less participants. But as more and more participants with the longer term time frame start involving or participating in the market, there's this amplification going on of this asymmetrically orientated financial market series. And that's why I think naturally we will find that the best trends are out in the longer regions. And that's confirmed when I look at, monthly charts and weekly charts. When you look at a monthly chart of any liquid financial data, you clearly see these very significant trends in that monthly data. So if I go over, 10, 20 years, and in nearly every liquid instrument on a monthly time frame, I see these significant trends. And I'm thinking to myself, well, why don't trend followers prosper at all times? And that's because the monthly trends are being dictated by the significant material price moves as opposed to the noise. And there is so much noise associated with price data. You need loose pants and these long-term models to basically capitalize on those major secular moves in the monthly trend.
Richard, can I ask you something? Don't you think that I agree with you, but don't you think that that noise just disappears very quickly? Meaning that all the guys who are trying to earn from the noise are in a very, very short period, or very short, below 1 day or maybe below 3 days. Because if they go further, they will have a huge price risk. The risk that all these institutionals screw their strategies, and the strategies have such good measurements in the very, very short term. And what I'm trying to say about this is the original periods of the turtles, etc. Shouldn't that be still be a valid strategy, since they are long enough to not get that noise? Or is that noise goes through the 20, 30-day period in your opinion?
Look, I think the markets have a life cycle. And so, the early days in the 1980s, I think that there were far less participants in the market than there are today. So the nature of participation back in the 80s, there was, of course, Jerry and a few turtle traders, and there was, these different convergent traders applying their predictive models in that environment. And but as the market matures, inevitably more and more participants with different behaviours start sort of interacting with the market. So the nature of this interaction with more and more participants, it's like an ecosystem of different types of participant behaviours. They cancel each other out. They're creating this amazing noise in that financial market. So the nature of trends in that financial market are still there, but they're much more influenced by noise. So the trends of today, I think, are different to the trends of the 1980s. So the models that were applied back in the 1980s, which might have been much more short-term and medium-term in nature, were very effective back in that those early days of that sort of that market development. But now, with the nature of participation, you need many more participants' behaviour interacting in that market. The trends are much more complex, less well defined. You need much more looser pants systems. You need much more longer term systems, because the nature of this amplification of these trends is sort of over many months to years, etc. By virtue of the fact that it's like a sea of noise, a sea of waves of different wave behaviour that a lot of them cancel out, but there's a few rogue waves amongst them, and they're the rogue waves are the things that we jump on.
Cool, thanks. Because I was thinking about the guys like Renaissance, all the high frequencies, etc. And by logic, I thought these guys won't go further than one day, or at tops 1 week, and I think that's too much risk for them. So I thought the 10-day period, the 20-day period, the 30-day period should be less noisy, because all those guys aren't there. And who is there on the 20-day period or 30-day period, etc.? I mean, it's too much risk to try to have a convergent strategy that is open for such a long time, for one trading month or two. But as you said, things change.
Yes, and I think the repeating patterns of price data, the predictable patterns, they're much more associated with the shorter term time frame. That's more a repeatable oscillation of a market. So certain markets display this convergent behaviour, and there's these predictable cycles of up and down around an equilibrium, and they're short term in nature, finite, ephemeral in nature. They might last 6 months, they might last 1 year, etc. But ultimately, when these patterns are detected by these predictive traders, they cannibalise that pattern, and their attack on that pattern basically changes or dissipates that pattern. So it's a bit like cannibalising those price patterns. But in our world of trend following, it's a different pattern, because it amplifies with greater participation. So if you can imagine, the number of trend followers in the financial markets or divergent traders might be about 10% of that market. 90% are probably predictive traders or convergent traders. So what we find is that when we find that these trends start getting significant, material in nature, it's these predictive modelers that find that their models are breaking down. They're therefore getting out of their predictive behaviour, because they're getting squeezed to death. And in that process, there's a mass wealth transfer to the 10%. So it might go to 10, 12%, 14%, 15%, but there's a long way to move before we start seeing that trend dissipate, from 10% up to 50%. When you start getting significant numbers of people all doing the same thing, ultimately the trends end. But there's a long way to go from the early days of trend materialization to when the trend ends, with some of these outlier moves. And I think that's because of this massive wealth flow that occurs when these predictive modelers get it wrong with their short-term predictive sort of trading methods.
As I have said before, that I have mentioned that when I'm doing short-term trading in a short-term space, I need more bells and whistles and some different complex decisions for that. A lot of filters, maybe not a lot, but 2 or 3 filters, I think, at least. And I'm not so sure that this approach is a safe method. I don't think that there will not be such a situation where I can lose a lot of money with this. So I'm talking about short-term space now. And in a long-term space...
Did we lose Oleg?
I think so. He might
okay, good. Well, not good. I meant good that I won't cut him off. I wanted to ask Richard, do you see any sort of building on what you just said, do you see any sort of issue as it relates to the managed future CTAs overlaying on top of whatever trend following they still do, a lot of money management and correlation management, the volatility management as sort of patterns that they have picked up in order to from the back test, that in order to maximize the Sharpe ratio or some ratio that uses volatility, that these sort of trades that they're doing are subject to the same problems that you were mentioning for traders that are in the shorter term space. And we sit out there with our long-term exits and loose pants and really kind of not paying attention to patterns in the same way. We've obviously back-tested that, and it works to have those sort of look-back periods for the exits. And is there some sort of meaningful difference between the two where, I don't know if it's our passivity or is there like, do you think that the managed future CTAs are kind of, could be in a situation where the patterns that they've uncovered, that they too could change, that could make it very unprofitable in the future as they kind of get cannibalized for these to continue to get out of profits, not because of necessarily trend change, but to get out of them because of the vol and correlation management overlay, that would be kind of a weakness of theirs, similar to the shorter term traders.
Yes, Jerry. So I view this style drift that we're seeing in a lot of these CTAs as the CTA's attempt to respond to investors' desire to smooth the volatility. And so I'm seeing these techniques, their overlay techniques that they're applying as methods to exploit the trending environments that we're not interested in, the trending environments that occur in the bulk of the distribution. So there might be trends associated with mean reversion, or there might be these other forms of trend that are not these enduring directional anomalies that we focus on out in the tail regions. So what they're doing is with these overlays is that they're certainly blending a touch of convergence with divergence, which necessarily it does smooth their portfolio returns. But I do believe it leads to a degree of warehousing of risk in their models. And I have seen a number of trend following programs such as Fort. And there are a couple of examples in March which I thought, gee, they were extreme negative moves because they were clearly overexposed to bonds. But I'm seeing this dispersion of returns where they might last for long periods of time, producing these wonderful smooth equity curves. But when there are these significant regime shifts, I do see some of these programs get significantly overexposed to adverse risk. Fort was a classic example. So these overlays, things like Campbell focus on a lot of overlays in their models. Graham focuses on a lot of overlay of their models, etc. Whilst it is popular to investors because they get a nice smooth ride, and I do believe this style drift we're seeing potentially does lead to these risks over the long term. And I do feel that a lot of these programs have over-optimized their performance in relation to the last 10, 20 years. I saw that with Winton Capital. I saw that with a few other programs. So there is this degree of over-optimization, smoothing, correlation management, all of these techniques that are being applied. They sound great, but I do think it leads to warehouse risk and the potential when we get a significant regime we've never seen in that back test. I don't necessarily think they're going to cope as well as we do because pure methodology, it's very pure. It's focusing strictly on the tail regions. We're not compromising that principle with convergent tactics. We're not compromising that principle by trying to adjust the necessary volatility that's in our equity curve, because volatility in our non-linear world is a sign that everything's good, a sign that everything's fine. You can't put straight equity curves into a non-linear world. And those that do are going to find that they've got the potential symptom of a long-term capital management on their hands, where they suddenly find when the regime switches, they're left wanting.
Yeah, Niels and Alan started. They did a good job, of describing what happened in March as it relates to this vol management. And I guess what they were saying is that, well, at some time in March or before March, the vol in those interest rates slowed down. So they added 2 positions. And then later, as the vol picked up and we were having a bad March, they reduced those positions. And then the interest rates went back down. Oh, yeah, so that didn't really work. And then they were getting into all these discussions about how, is it a trend change or is it a vol risk reduction thing? And it was just getting so confusing that I think part of the reason I like doing it this particular way is that I don't look at my trades and have all that much regret. The regrets are usually just totally focused on the drawdown, which you're like, well, that's a pretty big regret. And that happens a lot in these trades. I'm like, yeah, sure. But I look at my trades and I just see so many trades I didn't do, because I have loose pants and the market, about the time you think, well, this market's going to go down, you get out, it goes right back up. And so all the trades that I avoid, they just relax my brain, and it doesn't cause me nearly as much anxiety to continue to be bombarded with the fact that we don't know what these markets are doing. We can't predict them. These systems are not that great at doing trades and getting it correct all the time. So just do fewer trades, and you have fewer issues with this psychological beatdown of every time I sell, it goes up. Every time I buy, it goes down. So I just think doing less sometimes, even though doing less is great, and you have a smaller number of psychological problems, the ones you do have are bigger because it's bigger give back. So I just think that, and that's the kind of point that I try to make on all these podcasts, is that there's just pros and cons. There's pros and cons to all of these things. And using this vol and correlation management just creates all kinds of chaos sometimes. You just get it wrong, trade after trade after trade, and then sometimes it works wonderful and it's perfect. And what I do is way more painful. But I think that March thing is a good indication of, as I said before, if you're into this because you want to be on the right side of the trend, taking off positions or putting on positions based upon the volatility or the correlation is not a good substitute for trend following with breakouts or moving.
Yes, Jerry. And look, one of the big things, our simple approach, we know when our models stuff up. It's easy to understand the reasons why we perform badly during a particular period of time, because our models are very simple. And it's very easy to interrogate our process to say, that's where the weakness is, because it is so simple. But with these much more complex overlays that are being performed, correlations, volatility, dynamic position sizing, you name it, you start wondering, where is the problem? Is it in the dynamic position sizing? Is it in the volatility adjusting? Is it in the, all of these complexities make it so much hard to decipher why your model is underperforming in a particular period of time. It could be numerous factors, or it could be a single factor, or it could be a combination of factors. You just don't know. But what gives me peace of mind is that our process, we fundamentally understand the logic, the nth detail. We understand what our models are supposed to do. So it's quite clear to therefore be able to map that performance against the price data. But when you have these complex overlays, it becomes a minefield to navigate where the problem is. What's the problem underlying the model? Why is it underperforming?
I like these thoughts, and I think that a lot of problems comes from the warehouse risk situations, and people do not understand this. They like how it psychologically looks when it's a lot of complex decisions, a lot of why answers to their questions from the managers, and they all like this. But after the big crisis comes, they understand that risk was there, and it was only warehouse and risk situation. All this complex filters, all this prediction, all this role targeting, and of course, the more complex we are, I think that the more fragile we are.
I think it would be fun to talk about another part of that podcast, which I found was absolutely fascinating. And it was this idea that I think it was a paper that someone wrote. Can't remember who, maybe, can't remember who the paper was from, but they talked about a couple of papers on the podcast. And I wasn't able to tweet all of this, so I've got to kind of go by memory on most of it. But sort of this idea that someone wanted to analyze what machine learning would do in the bond market trades, in the interest rate trades. So they ran this back test and training. At one point, they called it overlearning. I think that's pretty funny. And they said, okay, these machine learning, it kind of over optimizes or overlearns. And so they limited the data to, to the bull markets. They said, okay, when the bond markets were all going up, which they did a lot prior to them going down a lot, then the machine learning came back with this idea that basically you get in when they start going up, you buy the breakout, and then when it goes up, you keep buying, and then at some point it goes up so much you get out of a bit, but then if it goes down, you buy more. Okay, and so then that's what it was doing, and that's how it learned. And so then on the short trades that we did last year, it said, kind of the opposite. Okay, you sort of sell the breakout and then you add to it. Then if it goes up too much, if it goes down too much, you get out of some. It's kind of oversold. But then if it goes down a bunch, get back in, buy more, because you sort of buy the dip. And then that worked well. And so then they said, okay, let's combine these two periods. I don't know if it was like 20 years or just the two periods. And so we have bull market in bonds and a bear market in bonds. Let's combine these two and let's get machine learning to tell us what to do. So it's going to go in and learn from both periods. We're using all the data from the bond markets. And of course, basically Alan's conclusion, I tweeted this, was it does pretty much exactly what a trend following moving average would do. I mean, I thought that was funny.
I would say that this machine learning techniques that I think something with my technology, but I hope I can speak now. I don't know. I want to say that these machine learning techniques, they deal only with the past, and we have logic and we have philosophy behind our system, and they only deal with data, and the future is unpredicted, and we can't predict it.
Yeah, but even when you're looking into the past, you would want to look into, a 1960s and 1970s where the interest rates are going up. So it's not a matter of, whether AI is doing a bad job in modeling trend following. It's just about, whether your data and whether your backtest period is making sense. So if you're gonna just look into where the interest rates are coming down and you're going bonds long, Of course, your back tests, whether you're doing it at the back of an envelope in an Excel environment, or you're using artificial intelligence, is going to be wrong. So this is how I see that experiment really. So that's why it is very important to be using extremely long term data to be able to come up with the parameter sets that you are able to trade. And if that data set is not available, then your next bet is, of course, to be able to give room for any outcome. So if you're just testing with 20 years data, and only if you're seeing basically interest rates are going down and bond prices going up, you might have to do the smart thing and say, hey, my data is not limited, is limited, and it might give me a limited belief about how markets and how the world might work. So I might be just better off taking smaller positions and just consider that the bond prices may go up as well as down. Usually being non-dogmatic in the direction of your trades, like taking long trades and short trades, and not over emphasizing in any direction, is a better risk management, I would say. Thanks.
Yeah, but I
I
think
think
that learning from price data, I think this is one of the things it's saying. If you're just going to feed me price data, I can give you the wrong answer unless you use all the data. And so you don't want to do that. So if you give me all the data, I'm going to look like a trend following thing. So, okay, all right, that's good news. I like that. And okay, so then if you ask it to learn off of something else, then it's never seen COVID before. Okay, so I missed on COVID. I'm not going to miss the next time. So it's just a house of cards. It's going to fall apart. I've often said that in jest that yeah, that machine learning and AI will work just fine as long as the last piece of code is buy the breakout or sell the breakout.
Yeah. So the problem with the machine learning is that, when you look at other complex adaptive systems like the history of our planet, you find that there are these periods of stable regime punctuated by these transition events. And these transition events actually reassemble and totally change the nature of the market going forward into the next regime. Then there's a period of regime stability, and then there's another transition event. So, these transition events are these epoch moments, things that can never be predicted in advance. When, amphibians came out of the water onto the land, or when lungs were developed, or when eyes were developed, or, these transition events are the things that, in our financial market terms, are what we're capitalizing on with these outliers. They're these chaotic anomalies that restructure the very nature of the market. So machine learning is something that is very efficient in stable regimes, looking at the predictable nature of price during stable regimes. But when you get these transition events, and these transition events, they never repeat. They're never exactly the same. They're caused by these conditional events, and the nature of those conditional events and the way they restructure the entire financial system totally alters the next regime. We've got a new species evolving in the next regime, different types of traders evolving in the next regime. The prior regime might be the value investors. This regime, it's now the high frequency traders. The next regime might be the convergent traders. But the transition events, the outliers that occur that separate these distinct stable regimes, so what we're harvesting with our vast diversification, very low trade frequency per return stream because they're few and far between. But with our very diversified portfolios, we're managing to capitalize on these transition events. And so machine learning, I think, is always going to be one step behind us. I don't think, even with presenting all the data to them, that's simply going to say what has happened over history. But the next transition event is going to be caused by different conditional variables, different arrangements, Jerry was saying previously that history doesn't repeat, and he doesn't like the fact that it can even rhyme. And I suppose, look, I have used that term, that history might rhyme. What that means to me is that it's not a repeat of what's happened. It's a totally different event, but it may appear similar to what's occurred in the past. That's why it might rhyme, but it's never the same.
I think what's interesting is when we're thinking about machine learning, I actually think a bit different. I think in the short term, when you look at the short term, it will just exacerbate what we already have. So more convergence, because obviously when you use in the short term time frame, you have less paths to go. If a price is at a certain price and it's short term, there's less movement it can go to. So what it will do is it will push even more convergence. But on the longer time frame, I think and this is never possible, but if you would feed it all the data in the world and even then some, at some point, I think what Jerry was saying is correct. It would just become a divergent EMA or something like that. So I think it will just push the difference between convergence and divergence even more. And then also obviously we always say, like, nobody can predict the future. But I guess in the short term, it's easier to predict the future than in the long term, and that's why we have this edge to move more to the longer term, because the strategy that we use is more adaptive in that sense. So.
Oh yeah, and another thing that they said on the podcast, which is kind of interesting and obvious, is that I guess somebody ran this research. It was in a paper where they said, "Oh yeah, they were using methods to reduce the loss in March, and part of that was to reallocate away from fixed income and lever up the other side of the portfolio." I don't know if that's the same as vol management or whatever, but just obviously in my mind, it's a non-system trade, and they talked about a lot of these non-system trades reducing risk. They'd like to draw a big distinction between vol management, correlation management, and everything else, which is maybe like cutback rule if you lose money, or risk reduction methods. Or there was a CTAs who don't trade short bonds, and that could be okay. They don't do it. And I think there's a bit of truth in that. If you never do it, and you're not going to discretionarily pick and choose when you're going to do it. And they were like, yeah, we don't like to trade short bonds because they can rally a lot during a big stock sell-off. And so that's a little bit of Stockholm syndrome there. But anyways, I don't think that's all bad. And then there are people who didn't trade at all during COVID, and they just were like, yeah, we're not going to trade. It's too crazy. It's too volatile. And then I think Alan said, but other people would say, well, that was the time you should have been harvesting premium, trend following premium. Okay, so a lot of that stuff gets criticized, and distinguished between other non-system trades, which is vol management, correlation management, which I don't like necessarily any of it. And I think the bottom line to any kind of risk reduction, like I do like the cutback rule, when you reduce your positions if you have these fatal drawdowns in order to stay in the game. But I think that the most important thing about the cutback rule is have a system that doesn't need it very often or ever, or once every 2 or 3 or 4 years. And then of course, a lot of that's dependent upon the risk budget. And your risk budget is too high, like the turtles, then you're frequently using the cutback rule. So you don't really want to use the cutback rule, because when you put the cutback rule in the back test, it says you'll make more money if you just trade smaller. Yeah, because the computer always favors the core system. And it doesn't see anything other than the core system as anything other than you're not being disciplined. And that's the problem. But I'm in favor of that, but not more than like once every now and then, and only because you need to reduce risk sometimes to stay in the game and preserve your capital. Although usually when I use the cutback rule, it was the low in my equity, and then it was hard for me to get back to all-time highs. And he mentioned that Harold says this as well. He's like, I don't like to cut back when I'm losing money, because if I'm in this drawdown, how am I going to get back to all-time highs? And then Richard and I think that's one of the reasons we are like, yeah, we kind of agree with that. And one of the benefits of using your closed equity balance as your trade level is that you're trying to defend that, which doesn't need defending very much. And the best way to maximize that is just to follow the core system, where if you're putting yourself in a situation where you're trying to protect all-time equity highs all the time, oh my God, your job is so much harder, so much more difficult. And you've got to introduce these methods that inevitably can easily accurately be described as overlays and not part of the core system. And the only way the computer likes that is if you throw in Sharp. Oh gosh, I'm so far off where I was going. Now, okay, here's Alan. You would be better off reallocating the risk away from fixed income in March to lever up the other side of the portfolio. I think the March loss was reduced by about 4%, but in 2022, instead of making 27%, and this is the SocGen CTA traders, instead of making 27%, you would have made 6. So this is, once again, this is the trade-off, the pros and cons. If March is an itch that you've got to scratch, then 2022, was way worse if you implemented something that would help you with March. And this is just the first thing you figure out when you start doing back testing. I really want to get rid of these bad periods. But what does that do to the overall performance?
Hi guys. So, in terms of the credit trading, the way I do see it is these models work in such a way that you make money while at the beginning of the trend, or while you're within the trend, and towards the end of the trend following models will be basically losing money. And what it means is, for me, the way I read the data is there's nothing wrong with the March, really. It just means that, you're late to the game. You would rather be, trading a trend following program in January 2022 to be able to take the full benefit of the move in the credit space, rather than, if you would started to get engaged with a trend following program in 2023, then it would be too late, and the March would be quite a painful loss. But the way I see it is just you're late to the game now. It means that you have to be riding the full length of the trend. What was the bear market? The bear market started in January 2022, so that was the start of a very good trend last year. So you're much better off to take those signals in 2022. In 2021, we had lots of commodity moves. Commodity signals were there. Lots of single name equity signals were there. So you were much better off to take those signals. And every year there might be some ad hoc signals, coming from forex or commodities or credit, but mainly there are some sector moves. So when a particular sector moves during a year, and if you're missing that, of course you're not going to see the benefits of it, and if you just catch that move at the end of it. So I think the point that I'm trying to make is there's a benefit in sitting with the program. You cannot just time your timing into the trend following trading. If you commit late, it's just not going to be good. But if you're entering some point, just make sure that you're riding the wave from beginning to the end to get the benefit of it, if it makes sense. Thank you.
Oh, maybe I misinterpreted all of that, but nothing that I was quoting him as saying had anything to do with when you entered into trend following. But I got distracted when you were talking out, so sorry. But
Uh,
no, it's not. Yeah, go ahead.
I mean, I think he was. So I've listened to the podcast as well. He was talking about the SocGen performance for the March, and how you would have had a much more smoother return than this chunky and lumpy loss that the trend followers had in March this year. And so, one of the options was to reduce the risk, as you have said, reduce the position size. That would have worked for sure, yeah. But the way I see it is, if you would have been trading that move at the beginning of it, yeah, I mean, you wouldn't you wouldn't be penalized in March, because you would be having 27% gain in the SocGen 20 top CTAs. So when it comes to the 2023, it's just a reversal of it's just the end of the trend, right? So in trend following, in my view, it just makes sense to write the entire move from the beginning to the end, and not try to get in the middle of it, or not try to get in at the end of it, where you're not going to like it if you miss some of the signals. So if it is making sense, Jerry, thank you.
And this is, as we've said before, many, many times, this is the whole problem. It's you're cutting those profits short. If you wanted to take care of March, what you would have done to have to take care of March would have impacted 2022 much worse. And so what he's saying is, um, if you're going to trade this way, um, it's going to have impact on other periods. Not figure out a way to trade 2022 without taking risk off, and then come March, figure a way to now's the time to take risk off. No, he's just saying if you change your philosophy of classic trend following and you say, I am going to institute this on my system to take off risk when volatility goes up, then you're going to have these unfortunate periods that are going to be impacted. And this is assuming you apply this rule of all your past trading and your future trading. Don't be surprised when everyone makes more money than you who just hung on to the trade. Now, one of the things that I totally acknowledge, I know how this works, and that is, yes. However, I would have traded larger in 2022 because I vol manage and correlation manage. So I would have levered up more than Jerry can because he's got this crazy performance going on. And that's the whole point. When Jerry adds markets to his trend following or adds systems to his classic trend following, he says, I can trade larger than trading 20 markets or in one system. That's 100% right. That's the philosophy of diversification. We can add more markets, up-lever the position, and there's no downside. And this is exactly the same thing that you could say, see I threw that you could say, not I say, but you could say, is what happens when you make the portfolio more efficient and more smooth. The additional markets that you add, the additional systems that you add, it makes things smoother. You don't have as big a drawdowns. Jerry leverages up. They do the same thing. Plus, they add the overlay, smooths it even more. So I'm not going to be trading that same size in 2022 where I would only make 6%. I'm going to be trading larger, maybe not enough to make 27, but then there are other years where it would be the reverse, where if you didn't use it, you would make 6, and if you did use it, you would make this 27. So it's really complicated the way people do things, and there's always a pros and a con and an impact, and then doing something that impacts that. So that's all I'm saying is that these things have you have to choose what you're going to do, what you believe in, stick with it, and when you make changes, you try to evolve, and you do change since 2005 to make things better, smoother, more efficient. Be careful that you have uncovered and everything that these changes may make inevitably cause changes that you weren't expecting. So, yeah, I think this was a really good podcast. They did brought up a lot of good pros and cons about the recent trading in these research papers, and give them credit for all of that. Now, I'm not going to be able to. We don't have time to get into all the criticism of classic trend following towards the end and all that stuff, but I did think it was a very interesting podcast.
One of the interesting things, to me at least, is that because I monitor the performance of these CTAs, I'm always very interested when we find the juggernauts in the space that have the smooth volatility profiles like Man AHL, Trans Trend. I'm always very interested when I see a massive dispersion in returns from other forms of trend followers. So in March 2020, I did see this massive dispersion. We saw, double-digit losses from, Man AHL, Trans Trend, a lot of the what I'm regarding as the more complex form of trend followers that aren't necessarily prescribing to just attacking these outliers, but and then when I compare that to, say, yours, Jerry, Chesapeake, which was heavily diversified, not so influenced in bonds, all of these things, I see a much better performance in March in comparison. When I look at Dunn, I see a massive sort of dislocation in March, but I have seen a massive resurgence in Dunn post March 2020. But it's always very interesting to me when I see this dispersion with these the volatility adjusters, the dynamic position sizes, all of those things, because that's what sort of is sitting in the back of my head, is revealing the possible weaknesses of their approach. Whilst they might argue that they're very strong over very long periods of time, I believe that there are certain sort of critical failures that are possible with those more complex methods in these turbulent regimes. And when I do see an instance like that, I start wondering how sort of robust are they? How smooth are their volatility curves? How much negative skew is embedded into their strategies? All of those things start coming to me saying, I'm wondering if something's coming back to haunt them from the complex overlays they're doing to their models.
Jerry, is it good to ask? Sorry, if I asked you about the ETF status, what could you say?
I would say mark your calendars for July 6th. So let me get in there first with my investment and then pile on in. But I'm joking. I'm joking on that. But yeah, it's full speed ahead. Yeah, should be interesting and fun. We're getting nervous. So it's a lot of complexity to, and it's just the number of markets is just so huge. People are like, I'm sure people are going like, is it really going to be 300? Seriously? 300? I want to see this. Honestly, it's 400 because, as I've said, in my strategy, I have some short-only stocks that I trade, shorts only. And I don't count those in my risk budget because a lot of the long stocks, they don't have much of a chance to be a short, the way I filter them out. So, but honestly, and then you'll only see the actual positions. So you will never probably see at one time, 400 positions, because we'll only have to show the positions we're in. But on my unit size sheet, it shows all of my positions, long, short, and flat. It's a bunch more than 300 because of the way I handle the shorts, and I don't have a tendency to jazz it up by saying, oh, I'm trading 400 markets, because it really, from a systematic, intellectual honesty point of view, it's really not that many, not 400, but it's definitely 300. But then I keep saying to people, okay, I'm done. I've chosen the 150 stocks, and we are finished with the stock portfolio. And they're like, we don't believe you. So, yeah, they know I can't be.
Do you ETFs require that you publish daily the holdings?
They do. I think that there are some loopholes around that. There are some, I think, but I don't. Someone showed me or asked me, was I going to do that, or was I going to avail myself of these loopholes? And I said, no, we're going to. You have to show the positions, and I think there's just so many, and they're so obvious. Obviously, all the currencies and commodities and interest rate futures. They're every CTA has those positions on, and probably in same or similar directions overall. It'll just be kind of humorous for you'll get a big kick out of laughing at my stock choices, like Tootsie Roll, Twinkies, Crocs. I take them mostly seriously, but some of the choices are, yeah, it's hard to say that I took them very seriously. I just thought it was kind of funny stuff from my childhood. And, I've said too that I think that the portfolio I've seen done research, and I've talked to people. And philosophically, I think for trend followers, you want to get that outlier, and you want to have. So probably for equities, you want to trade stocks alongside that are smaller in nature rather than mega caps that have less diversification, one or two products. A fundamental can come across that market, that stock, and have a big trend. So, although I also think that that's not always the case. That's the opposite of NVIDIA. I mean, look at that. So that's definitely, you're going to miss NVIDIA if you follow that logic. Although I looked up NVIDIA when it first started trading, and as soon as it started trading, it wasn't that long ago that it had started having its big trends, and its market cap was a lot lower than it is now. So technically, you I would have had NVIDIA in my portfolio back in the early 2000s, I guess. I could have if I followed the rules that I use today. So I would have had NVIDIA. Then you just got at some point, you say, okay, it's too big for me. I would take it out possibly, but that would have been a mistake in this case because NVIDIA, it just keeps going up. It's the best stock out there. So that doesn't work. And then also you throw in the trend following commandment that all markets have the same expectation, which I firmly believe. So maybe all of my thoughts about curating this stock portfolio for my strategy is just a waste of time. Take one or two from each industry group or sector, and that will do just as well as spending a lot of time trying to pick out undiversified stocks that are small and are not too diversified. But so I don't think it's just because I do it a certain way doesn't mean I'm going to, follow my sword like I would vol management and correlation management. We all have our limits of, to be honest with ourselves.
Right. By definition, each of us would have distinct systems and approaches, even if we were fully disclosed.
All right. 10:03. Anybody want to make a comment, become a speaker, spend another 4 or 5 minutes on any topic of your choosing? All right. It's been fun. Have a good weekend. See you next week. Good luck trading.
Good luck trading.
Thank everybody for being here.